Welcome back to Day Zero. I am the Sentinel. If you are listening to this, you are likely sensing what the majority, the sheep, are ignoring. You feel the vibration in the tracks, but you can't quite see the train yet. Let me tell you right now, the train is coming, and it has a number painted on the engine. That number is 2026. We are not here today to discuss stock picks or technical analysis of yesterday's charts. We are here to discuss a mathematical certainty, a convergence of timelines that the financial media is desperately trying to obscure with noise about a soft landing. The system is rigged to keep you in a state of perpetual optimism until the very moment the trapdoor opens.
For the last 2 years, the global financial system has survived on a mechanism called extend and amend. Banks and corporations have been pretending that their debts aren't toxic by simply pushing the due dates forward, praying for interest rates to return to zero. But I am here to tell you that the game of musical chairs stops in 2026. This is the event horizon. It is the point where three massive forces collide: a historic wall of debt maturity, a draconian change in banking regulations known as Basel III, and the onset of total fiscal dominance. The math dictates that by 2026, the strategy of kicking the can down the road hits a dead end.
There are three specific asset classes sitting in your portfolio right now. Assets that your financial advisor probably tells you are safe or diversified, that are mathematically destined to go to zero, or close to it, when this clock strikes midnight. This is your countdown. This is your chance to escape financial servitude before the great wealth transfer begins in earnest.
Let's dismantle the machinery of this coming collapse.
To understand which assets to dump, you must understand the liquidity trap that is being set for 2026. The entire soft landing narrative of 2024 and 2025 has been built on a lie. That lie is that the economy can handle 5% interest rates indefinitely. It cannot. The only reason we haven't seen mass defaults yet is because of the extend and amend strategy I mentioned. Borrowers with loans coming due in 2024 were allowed to extend them to 2026, hoping the Fed would save them by then. But look at the data. The volume of commercial real estate, CRE loans, maturing is set to jump nearly 19% in 2026 compared to 2025. We are staring at a maturity wall of over $1.5 trillion. This isn't just a wave. It is a tsunami of debt that needs to be refinanced.
Here is the failure point. In the past, when a maturity wall hit, banks would just lend more money. But in 2026, they cannot. This is where the system failure becomes structural. Implementation of the Basel III Endgame regulations has been delayed, but it is now targeting full impact for the 2026-2027 window. These regulations fundamentally change the amount of capital banks must hold against their assets. It is estimated that these rules will increase capital requirements for large banks by up to 21%. Think about what that means. Just as trillions of dollars of desperate corporate and real estate borrowers show up at the bank window begging for a refinance to avoid bankruptcy, the regulators are slamming that window shut. The banks will be forced to hoard capital, not lend it. This creates a credit crunch of biblical proportions. The liquidity tap runs dry exactly when the thirst is greatest. And looming over all of this is the specter of fiscal dominance. The U.S. deficit is running at nearly $2 trillion a year during peace and prosperity. The government has to issue so much debt that it crowds out every private borrower. The Fed is no longer fighting inflation. They are fighting sovereign insolvency. They have entered a regime where they must print money to fund the government, regardless of inflation. This debases the currency and destroys the real value of paper assets. So, with this mechanism of destruction understood, let's identify the casualties. These are the assets standing directly on the tracks.
Asset class number 1, the toxic twins.
Regional banks and commercial real estate. You might think the banking crisis of 2023 is over. It is not. It was merely paused. Regional banks are sitting on a time bomb of commercial real estate loans. Data shows that nearly $1 trillion in CRE loans mature in 2026 alone. The extend and amend game has allowed banks to value these loans at 100 cents on the dollar, pretending the buildings backing them are still worth what they were in 2021. They are not. Office vacancy is structural. The return to office failed. In a true mark-to-market scenario, many of these assets are underwater. When the maturity wall hits in 2026, borrowers will not be able to pay. They will hand the keys back to the banks. The banks, forced by Basel III to recognize these risks, will see their capital evaporated by these losses. If you are holding regional bank stocks, KRE, or REITs exposed to office space, you are holding the bag for the great wealth transfer. You are the liquidity they will use to exit. Asset class number 2. The zombie horde. Speculative corporate debt. We are witnessing a plague of zombie companies, firms that cannot pay the interest on their debt from their operating profits. They only survive by borrowing more. In the era of zero interest rates, zombies could live forever. But in 2026, the cost of debt will not be zero. The number of zombie companies in the US has surged to the highest level since 2021. These companies have debt maturing in 2026 and 2027. They issued junk bonds at 3% or 4% a few years ago. In 2026, they will face refinancing rates of 8%, 9%, or 10%. The math is brutal. If your interest expense doubles, but your revenue stays flat, you are insolvent. We are looking at a wipeout in the Russell 2000 and the high-yield junk bond market. Roughly 40% of the Russell 2000 is unprofitable or struggling to service debt. These are not value stocks. They are value traps. They are the canary in the coal mine, and the canary has already stopped singing. Asset class number 3. The safe haven mirage. Long-term treasury bonds. This is the most controversial, but perhaps the most dangerous, because it is where the sheep feel safest. For decades, the 60-40 portfolio told you to buy long-term government bonds to protect your wealth. In a regime of fiscal dominance, that logic is inverted. When the government is issuing debt to pay off old debt, they are actively diluting the value of every bondholder. We are entering an era of financial repression, where the government keeps interest rates below the rate of real inflation to inflate away their debt. If you lock your money away for 20 or 30 years in a treasury bond yielding 4%, but real inflation, driven by tariffs, deglobalization, and money printing, stays sticky at 3.5% or 4%, you are running on a debt treadmill. You are making zero real return while taking on massive volatility risk. We have seen that when inflation spikes, bonds crash right alongside stocks. The correlation is 1. The safety is an illusion. We have identified the rot. Now we must execute the extraction. The Day Zero plan is not about getting rich quick. It is about survival. It is about ensuring that when the smoke clears in 2027, you are the one holding the real assets, not the worthless paper claims of a bankrupt system. Step 1. The purge. You must ruthlessly excise the cancer from your portfolio. First, liquidate exposure to regional banks and commercial REITs. Do not wait for the headlines. By the time the news reports the bank failures of 2026, your equity will be zero. Second, dump the zombies. Check your ETFs. If you are holding broad, small-cap indices or high-yield bond funds, you are holding toxic waste. Sell them. Third, reduce your duration. Sell the long end of the bond curve. Do not lend money to a bankrupt government for 30 years. Step 2. The allocation. Where does the capital go? We pivot to assets that thrive in fiscal dominance and scarcity. Allocation A, gold. This is not a trade. It is insurance against a dying fiat system. Central banks know this. They are buying gold at record paces. They are dumping dollars and buying bullion. Do what they do, not what they say. Goldman Sachs, one of the architects of the matrix, sees gold hitting $4,900 by the end of 2026. Why? Because gold is the only financial asset that is not someone else's liability. In a sovereign debt crisis, it is the only king. Allocation B, short-term liquidity, T-bills. Cash is trash in the long run, but in the short run, it is ammunition. You want to hold short-term treasuries, 1 to 3 months. Why? Because when the crash happens, liquidity dries up. You want to be the one with liquid cash to buy real assets for pennies on the dollar from the distressed zombies. You stay liquid, you stay nimble, and you collect your 4 to 5% while you wait for the sale of the century. Allocation C, real assets, energy and commodities. The system is rigged to suppress energy prices in the short term, but the physical reality is undeniable. There has been a decade of underinvestment in oil and gas. We are facing a supply crunch in 2026-2027. While the paper markets might be bearish, the physical markets are tightening. Own the producers, own the commodities. These are inflation hedges. When the Fed prints trillions to bail out the system in 2026, paper money flies into things you can drop on your foot. We are approaching the end of the line. The period between now and 2026 is the twilight zone. The media will tell you that inflation is beaten. They will tell you that the banks are strong. They will tell you to buy the dip. Do not listen. They need you to stay fully invested in their rigged system so that they have enough liquidity to exit their own positions. They need a greater fool, and if you look around the table and don't see one, it's you. The great wealth transfer is not a conspiracy theory. It is a mechanical process of moving wealth from the holders of paper assets to the holders of real assets, and from the ignorant to the prepared. You have the roadmap. You see the maturity wall. You see the regulatory hammer. You see the fiscal trap. The only variable left is your will to act. Dump the banks. Dump the zombies. Dump the long bonds. Get real. Get liquid. Get ready. This is the Sentinel. Day 0 is coming. Class dismissed.